The third financial statement that you need to understand as a small business owner is the balance sheet. So in this seminar, I'm going to go through some of the stuff that you need to understand, some of the things that you need to understand on the balance sheet. And if you understand this, this is going to help you improve the way you manage your business. So let's get going and discuss, first of all, what the balance sheet is. The balance sheet shows all the assets and liabilities of a business at a specific point in time, usually the financial year end. So you'll see a balance sheet and it'll say the balance sheet of this and this incorporation as at the 31st of December 2015. That would be an example of what it would state on the top of the balance sheet. It shows everything the business owns and everything that the business owes. And it gives you an idea of the net worth of the business. So it's a very important document, and I would encourage you to discuss your balance sheet at the end of the year with your accountant or your bookkeeper, and also remember that your bank needs this document, and they'll regularly ask you for your balance sheet because they really want to see the condition of your business, how you're doing. So really, it's another way of showing how well your business is doing. And I'm going to give you a couple of examples. Let me just load the balance sheet template. So on the screen now, you will see a balance sheet for a business. And I've inputted some numbers in here for a small business. So on the left-hand side here, you will see the current assets. In this case, this business has $64,578 in the bank. It has accounts receivable outstanding on this date of $18,292.48. It has inventory of $72,456, giving it a total current assets of $155,326.48. So where did we get these numbers from? The bank comes from the ending bank balance specifically on the 31st of December, in this case of this business. The accounts receivable, you'll go and add up all the accounts outstanding that haven't been paid, and that'll give you accounts receivable, so really your customers that owe you money. And then your inventory will be the value of your inventory at cost. So these numbers are got from your business, from your bank statement, from your accounting system, you will get this information. So that's the current assets, and then we've got fixed assets. These are assets that you use to run the business. For example, some machinery, some equipment, or any vehicles that the business owns. So on the balance sheet, you'll see an example. Usually you'll just have the book value on your balance sheet, but I thought I'd explain it to you so you understand. In this case, we've got machinery of a book value of $40,200. We've got equipment of $7,300, and we've got vehicles of $27,000. That's how much it cost us. Then we've got the depreciation of $8,040 so far. Then we've got equipment depreciation of $1,460 and vehicle depreciation of $9,000. So giving us a net asset value or fixed asset value of $56,000. So our total fixed assets after depreciation are $56,000. And then I've just included a number here of other deposits. Let's say, for example, you may have paid an electricity deposit or other deposits that we pay in business sometimes to our suppliers. That is an asset because it's money owed to you. So in the case of this business, its total assets, everything the business owns, is $215,826.48. So that's the total assets that the business owns. And then we have the liabilities, or these are the things that the business owes. So let me give you some information here. In the case of this business, it has some current liabilities. These are ones that change regularly, usually on a daily basis, actually, if you think about it. The accounts payable, outstanding at the year end, are $68,765. So this is how much money we owe to our suppliers. We owe some taxes of $2,374. and we've got a line of credit of $38,500. This is the outstanding amount on the 31st of December. So our total current liabilities in this business are $109,639. Then we've got long-term liabilities. These are usually items that are paid over more years. Let's use an example. You might take out a bank loan, say for 5 years or 3 years, that we'd call a long-term liability. What you would do at the end of the year, you would take the outstanding amount. So you phone your bank or go onto your bank statement on the internet and see exactly how much is outstanding to the bank, the capital portion. So in this case, it's $43,632, so giving us a total of $43,602 total long-term liabilities. If you had a mortgage, you would include it in there. If you had any other loans, you would include it in there, okay? So you got a total liabilities of $153,000. This is owed to banks, owed to your suppliers. So these are the total amount, $153,000. Then we've got the owner's equity. So this is owed to the owner. The owner's given a loan of $35,000, which will need to be repaid over time. And then it's got retained profit, which comes from the income statement. This is profit that is left over in the business after we've paid our income taxes. In the case of this business, it's $27,555.48. So the net asset value, or the total owner's equity as we call it, is $62,555.48. Okay? So this gives you your balance sheet. You'll see your total assets, and then your total liabilities and your equity. That is your balance sheet. So understand that your accountant's going to do this for you every year, and I would encourage you to sit down and discuss it with them. Look at things like your accounts receivable outstanding. Look at things like how much money do you have in the bank. Look at your inventory. You might realize it's too high or too low. These are some of the things that you would look at and you would analyze. Now, when it comes to your bank, there are a couple of things that they want to check. They want to see if you're looking for a loan, whether you can actually afford this loan. So they use a couple of things they call ratios to calculate if it's possible to loan you money. The first one they'll look at is your current ratio. What they're looking at here is, do your current assets cover your current liabilities? So let's use an example. Let's say all of a sudden, all your suppliers, so let's look at the current liabilities, your suppliers, Canada Revenue Agency, and your bank said to you all of a sudden, you know what, we want you to pay us back straight away all the money that you owe us. And what this number tells us is, do we have enough money to cover these? In the bank, our accounts receivable and inventory, do they cover these? And in the case of this business, the number is 1.42. So it covers it quite well, okay? So that is the current ratio. And the bank would have a number that they're comfortable with, that they would measure, and this would influence their decision about whether they would finance your business or give you a loan. Then we have a thing called a quick ratio, which is also your current assets divided by your current liabilities, except that you deduct the inventory of your current assets. And the reason you would do this is if you're in a business where the inventory is not that easy to turn into cash. Okay, so that's the reason your bank would use that quick ratio. And the other one that they look at is the cash ratio. So do you have enough cash in your business to pay your current liabilities? Okay, so would look at this number, and they've got a number that they're comfortable with that'll help them make the decision whether they're going to finance your business. And the last one we've got here is your working capital, which are your current assets minus your current liabilities. So let me warn you that balance sheets, if you're not an accountant, can sometimes be a little bit challenging to understand. So I recommend you sit down with your accountant and let her explain to you what your balance sheet says. What are the assets? What are the liabilities? And really, what is our net asset value? How are we doing in our business? Let me just show you, because often business owners wonder, why does the balance sheet always balance? So I'm going to give you a very, very simplistic example so you'll see that there's no magician involved here. It's really quite simple. So let me show you an example. Let's say I start a brand new business. I'm going to open a retail coffee shop, and it's going to cost me $100,000 to open. Let's assume that, okay? So where would the money come from? So let's say I gave the business a loan of $50,000, okay, myself, and let's say that I got a bank loan of $50,000. Okay, so I got a bank loan of $50,000, and I got a loan from the owner for $50,000, giving you $100,000. Where does that money go to? So if I give the business $50,000, it'll go into the bank account. If I get a bank loan of $50,000, it'll also go into the bank account. So there you go. So we've got $100,000 in our bank account, which there you see our balance sheet balances. There you go. We've got total assets of $100,000, which is money in the bank, and we've got total liabilities of $100,000, which is $50,000 from the bank and $50,000 from the owner. Let's say, for example, we now go out and purchase some equipment. We buy equipment for $30,000. Okay? So where will this money come from? If we're buying the equipment with money that we have in the business, it'll come out of our bank account. So our bank account will come down by $30,000. There you go. So you've got $70,000 in the bank now. You've got an asset, which is your equipment of $30,000, giving you a balanced balance sheet. There you go. So now we decide we want to buy some inventory to get this coffee shop up and running. So let's say we buy $5,000 of inventory. That'll come out of the bank balance, and then we'll have an asset of inventory at cost of $5,000. There you go. Your balance sheet balances. You see, on every transaction has a direct impact on your balance sheet. Let's say that $5,000 of coffee, we sell it for $15,000, okay? So we've got no coffee left. We sold it for $15,000, giving us $80,000 in the bank, and we made a profit of $10,000, okay? We sold the $5,000 coffee for $15,000, which went into the bank, and there you go. You look at the balance sheet, and it balances. You understand that every transaction has a direct impact on the balance sheet. If you spend money, it'll reduce your bank account, and it'll increase your assets, or it'll reduce your profit. So when it's an expense, it reduces your profit. When it's an asset, it increases your assets. So this is why the balance sheet always balances. But let me encourage you to go and sit down with your accountant once a year and understand how you're doing based on the balance sheet. So at year end, you'll discuss two financial statements. On the one hand, you'll discuss the profit and loss, which we call the income statement. That'll tell you how much profit your business did. The balance sheet will tell you what assets and liabilities the business owns. And remember that your banker wants to look at your balance sheet. They want to see how liquid you are, what working capital you have, and whether they take a risk based on the assets you have on your balance sheet to give you a bank loan. So your balance sheet becomes very important when you're trying to raise capital. So keep this in mind, use this information, and you can build a successful business. Now, let's just discuss what you should be doing as a business owner. I mentioned this earlier on, but discuss your balance sheet with your accountant every year. You don't have to know how to do the balance sheet. You just need to know how your business is doing. They will explain it to you. Develop a strategy to improve your balance sheet. So how do you improve your balance sheet? By maybe purchasing more assets that'll be on your balance sheet and retaining more profit in your business. So instead of paying it out as dividends or instead of taking it out as a salary, leave it in your business as an asset, because it'll make sure that your business plan looks solid. And monitor your ratio. So sit down with your accountant and let him or her explain to you the ratios. And remember, this is an important thing if you're going to your bank. So use this information to help you become a better business owner. I encourage you, if you've got any questions about the balance sheet, make an appointment with your small business consultant to Enterprise Toronto, and they can guide you or at least tell you who to go and speak to understand the balance sheet much better. Understanding the balance sheet is going to make you a better business owner. So sit down with your accountant annually and discuss your balance sheet. This is good for your business, and it'll also make you feel like you know what's going on. Best of luck to you all.